Vulnerability of the U.S. banking sector. The regional banking sector has been front and center for a while now, ever since the collapse of Silicon Valley Bank in California. Yesterday, of course, TD Bank pulled its deal with First Horizon. And today, PacWest is looking at asset sales, according to a report. We're joined now by a featured guest of the morning. He's Anish Chopra, partner and portfolio manager at Portfolio Management Corporation. Thanks a lot for coming in.
Thanks for having me.
You've got lots of thoughts, and this is a good day for them, on how investors should be thinking about the U.S. regional banking crisis. You think it's not over yet. Still a very volatile situation. Today, for instance, shares of some of these beaten down banks are actually rising.
For sure, it's a tough situation in the regional banking sector, and you're going to have these bounces, right, periodically. But the fundamental business problems haven't been resolved. When you look at the general banking model, what you have is what's called borrow short and lend long. Right. So the depositor puts in money, but they can take it out later that day, the next day, next week, whatever. But the bank has to figure out how to make money on it, and they'll put it away for, let's say, in a loan for 5 years, but you got to match that. So that's sort of the fundamentals of the business. But when you look at what's happening in the regional banking space, it's good to break it apart into two areas. One's the business of the regional banks and how that's working. And then there's what I call the investment market dynamics, which are also helping to drive some of the outcomes here, in addition to the basic business of the banks.
One of the big problems, it was the problem at Silicon Valley Bank, is that the banks over-invested in long-dated U.S. treasuries, and that the value of those treasuries sank as interest rates rose, correct?
Exactly. So if you take a step back and say, okay, let's simplify a regional bank, right? You got deposits on one side, and then you got loans on the other side. And then when you have those loans, let's break it down into just two: commercial real estate loans, and then loans to the U.S. government, so these treasuries. And then, as you mentioned, Paul, when you have the U.S. treasuries, the big event over the last year in the financial markets is really interest rates went up a lot. And those banks had effectively put their money away for 10 years by buying U.S. treasuries at low interest rates, because they were making at least some spread over what they were paying out on the deposits. The problem is, when interest rates rose a lot, the value of those U.S. treasuries fell. And the market looked at that and said, whoa, 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 you've got a lot of losses. Something could happen here if you have to sell it in the marketplace. But in this case, the Fed stepped in and said, don't worry about that. You can give it to us and we'll pay you full value, as opposed to the market value, which is much less in the current rate environment. So problem one solved. What
about real estate values post the pandemic and the ongoing work from home period? We're hearing about office vacancy rates in some major cities into the mid-teens.
Right. So when you go back to that simplified U.S. regional bank, you've got deposits, you've got two types of loans. You've got the U.S. Treasuries, so they bought U.S. Treasuries, or they invested, let's say, in commercial real estate. It's that regular aspect of the bank now that's coming to haunt them, which is the regular business of the bank, which is making loans. And if you look at the commercial real estate sector, that's a big chunk of where a lot of the regional banks have put their money. So they're going to be facing losses on that side of the bank. The problem is when you've got, and you have to match that with deposits, right? So investors are looking at these banks saying, why would I want my money there if I'm always concerned about not being able to get my deposits out, especially if I'm above the $250,000 FDIC guarantee. So in that case, they're saying, I'm really worried about this. Why don't I pull my money out and go to a bigger or a different bank? So you've got the problem of deposits leaving, which is tough to solve, right? If people get concerned, they were very concerned at Silicon Valley Bank because the Fed hadn't stepped in to solve the Treasury problem, right? So it's like, oh, I better manage my deposits. And then you've got this commercial, there's going to be significant write-downs of the value of those loans in the regional banks. So you've still got the play of the regular business of the bank, the loans, and then deposit outflow, especially over that $250,000 cap.
How much of a headwind, how much of a negative do you think it is for the broader market? The optics of bank failures are horrible. However, these are not giant Wall Street banks, which appear to actually be getting stronger through this process. And there has been a willingness of regulators to move fairly quickly.
Right. I would think that the problem would be contained. I think the biggest shock to the market came in the first set of failures earlier this year, because we had a few banks go right away in 1 week. The market's now used to it, right? The market sees the problem, the Treasury problem, held to maturity losses, that's been solved for. But now it's the regular banking losses in lending. So, but the market's aware of the problem, and the market will sort out over time the winners and the losers.
Do you have any exposure to U.S. banking on behalf of clients?
Yes, on the large scale banks like J.P. Morgan.